And welcome to Lecture 6, included in Section 2 of the course, entitled Sorry, Miss Cleo, it's about possibilities, not predictions. So like any other analytical technique in trading and investing, such as fundamentals, price action only gives you possibilities, not predictions. And this is very key to understand because just like fundamentals, you're never going to know 100% of the situation. The charts and price action is never going to give you a 100% accurate signal as well. So price signals are only a hint that something's likely to occur, a big trend, a breakout, a continuation, a reversal. There's no crystal ball that's involved in price action at all. There's just too many factors at play. And so we want to come into a price action system with the expectation that it's not going to be 100% accurate every single time. So this is what a price action system really is doing. It's projecting out possibilities. And that's why we have a cone here saying that FSLR can end up in any one of these areas at the end of time of this cone. It's forecasting where FSLR will be. Now, this particular cone, since it's aligned straight sideways, actually implies that the signal has zero edge, right? So there's just as much likelihood that price goes up from the current point than down. Where on the other hand, we're hoping that our forecast cone looks something like this for a short. So FSLR, our signal was to get short on a break of this trend line. We're hoping that this signal plays out in sort of this fashion where we have bias to the downside, right? So there is some situations where we lose money or break even, but most of these situations, if you were to picture all the possible paths that play out, end in a lower price for FSLR. And that's what we're hoping that each of our price action signals gives us. But it's definitely not a complete 100% accurate prediction of FSLR will go down. All right, so it's not saying, hey, this thing's going to go straight down to 16 or it's going to go directly down as soon as this breaks. It's just saying, no, here's the possibilities of what can happen. And we're hoping that more possibilities end in this case, bearish rather than bullish. So don't expect really high hit rates when you're using a price action system because it can't happen. There's too much noise in the market, and there's a bunch of other factors that are affecting that market that don't have anything to do with the price that cause the signals to fail. So when a system starts to underperform, it's not necessarily a sign of concern. And I try to avoid tweaking it based on a few failed signals because that's going to lead to worse performance and put you right back onto that technical analysis cycle of death we talked about in a few lectures back, where you over-optimize, then the thing breaks down when the current market regime ends. So we don't want a chart looking like this, an indicator soup, where we have tons and tons of indicators in FSLR. We don't really know what's going on. We don't want that. We want to keep things simple because the best we can get is a forecast cone. We're not going to get an exact prediction of where price is going to go. So if trade signals are generating a 40 to 50% win rate, that's pretty good. We can make a lot of money off of that. And it's even possible to do that with a lower win rate of 33%. So if you have lower hit rates, that's all right. As long as we make more when we're right and lose a small amount when we're wrong, then we will be profitable. So you want to temper your expectations to avoid frustration and burnout and not expect to go in and say, hey, I'm going to get 90% win rate with, when I win, I'm going to win 10, and when I lose, I'm going to lose 1. That's not going to occur, and we don't want to set ourselves up for that type of expectation only to get disappointed down the road. And then we also need to let go of the need to be certain in the markets, and especially with price action systems. We need to allow them to have the noise and have the uncertainty involved with them. So if you're looking for certainty in trading, then you should just leave the game because you're never going to get that. So the reason why we like poker a lot and we play a lot of poker is because it's great cross-training for the markets. And poker is all about odds and probabilities and has a ton of similarities to trading because it's a game of imperfect information, right? You're never going to know what the other person's cards are. So no matter how much analysis you do and how much thought you put into trying to estimate what their two hole cards are, you're never going to know with 100% certainty what it is unless you're somehow cheating with some x-ray glasses or have some, maybe you have a live feed to the table camera and you're cheating in that regard. But there's just no way to know. So in poker, when we are playing against our opponent, and let's say we're this guy here over on the left, we're trying to determine what our opponent has, and all we can work off of is clues. So we know that the flop is ace, king, queen, and then the turn was a jack, so there's a possible straight out there if he has a 10. Maybe he was chasing that. We also know there's 2 clubs on the flop, so maybe he was calling our bets, trying to chase a flush. And say we bet pre-flop, we can guess that he might have, maybe an ace, king, or queen, because typically players like to call raises pre-flop with strong cards, not weak cards. So we can take those clues and try to formulate possibilities for what he has. Maybe he has 8-9 suited chasing the flush, or maybe he has ace 8, or maybe he has ace king. But we're never going to know for sure. We're not going to be able to predict with 100% accuracy what he has. So that's why we really like studying the game of poker, because it carries over very well to the markets, because it's the same thing when you're looking at, say, a chart. Where it's when a price signal fires off from a chart, there are possibilities for what could happen, but never predictions. And so we live in a world of managed uncertainty, and we love this term, managed uncertainty, because that's really what market speculation is all about. We're never going to know for certain what's going to happen in the markets. So we have to manage this constant uncertainty, and we make money by risking our bankroll on what's called positive expected value decisions over and over again. So a positive expected value decision is one in which over the long haul we'll make money. So if the factors aligned and you were to play out that situation over and over again and make your positive EV decision over time, that would be a profitable money-making decision. So think of trading in this fashion. It's going to be line items of wins and losses, and they're not all going to be wins and they're not all going to be losses. It's going to be a mix-up. So it's going to be, I have a win, then a loss, then a few bigger wins, then a bigger loss, then almost a scratch trade. So you want to be thinking in sequences, not one-off events. So you can't be frustrated when a price action signal fails, because they only work in the long haul over many iterations over the long term. And so if you align with that reality, then you're going to save yourself a lot of frustration and angst when the system doesn't necessarily generate 90% returns. And people fall into that trap all the time, where they expect, God's word or a holy grail signal, and they try it and they lose, and they completely throw away technical analysis or any type of price action analysis because it disappointed them and didn't give them the win rate they wanted. When in reality, it's actually adding value to the process. There just needs to be patience and correct risk management so you can let the system pay you out over time, over the long haul.